We begin today with the big issue, investors balancing caution with a seemingly impervious rally.
We seem to have reached a peak at the moment.
Profitability seems to be peaking.
Interest rate cycle has peaked.
The recovery is stalling.
I think it's not at the end. We're very near the end of the cycle.
Late cycle is now starting to transition to end of cycle.
Growth is moderating. It is slowing, but it is slowing to a respectable pace.
If we don't see a drop-off in demand, I think that this expansion can go on.
The markets definitely have some upside.
We can still rally a little bit.
Second half is going to be meaningfully better than second quarter.
Whether this continues really depends on whether we see any concrete progress on two fronts.
Trade fears and Federal Reserve fears.
Everyone's hunkering down, waiting to see what happens.
So the key question, is this as good as it gets? Joining me now around the table to answer that question, Leon Labrecque of Sequoia Financial Group, Michael Kushma of Morgan Stanley Investment Management, and Bloomberg's Luke Kawa. Michael, I want to start with you. When I say as good as it gets, I mean this everything rally where everything seems to have a bid. How long can this last?
It can last as long as the confidence in the Fed and central bankers around the world deliver on what markets expect them to deliver. But then it'll be up to the economy to actually respond positively to what central banks are doing. So we're in this Goldilocks period where there are people anticipating good things from central banks, but it may or may not work down the road.
And then there's also a question of where's the bottom here? Is it zero? Like when the Fed gets to zero, then we can call off the hounds and say, Leon, all right, now there's nothing left. Now we can look at the real economy?
We got to zero before. We could get to zero again. If you look at the German rates right now, they're negative. So the European central banks have already practiced this to no avail. I actually think the Fed is impervious to Trump's movements, but it looks very, very possible we'll have a 100% cut in July. And we'll get a couple cuts. But remember, the Fed's got two wrenches now. They can do the let-off. They can change their let-off as well. So we've got more tools in the Fed's
arsenal. When you say let-off, you're talking about the quantitative easing thing, stopping some of the maturity and that they don't reinvest.
Right. So if I'm the FOMC, I now have two knobs to play with instead of one. Before it was only one knob. Raise short-term rates, lower short-term rates. Now I can change the long-term rate as well. But, I mean, anybody wanting to lower the long-term rate, they've got to be happy, Michael. 201, what the heck? We just got a bonus. We got a dollar bonus. We got a lot of things. I mean, if the president wanted to make things happen, the market gave them to him. He didn't need Powell to do it.
All right, so, Luke, here's the question. How much more can U.S. equities rally from here just on a Fed that is increasingly accommodative?
It appears as though we're reaching limits in terms of what's priced in to euro dollars and the amount of easing that would be consistent with insurance versus an actual downturn. So I think we might be getting to the point
where... Parse through this. This is actually really important. In other words, there is a difference between signaling to markets, we've got your back, we just want to avoid overshooting, versus we are seeing some real issues here and we are concerned. That would be different, right? Exactly.
And if you look at the history of Fed easing cycles, and when the market calls for Fed easing cycles, you pretty much either get the amount of easing that's priced in the 90s experiences, 95, 98, or you get more. So to relate this to kind of the everything rally experience and what we're talking about, all of these four U.S. indexes, investment grade, high yield, agency and quasi-agency sovereign, and U.S. stocks all at all-time highs, this pretty much happens 0.2% of the time. So I think the bigger question for asset allocators right now is when your hedge is performing so well in an up move, what gives you the confidence that it's going to be your effective hedge when things go south?
That's a great question, Michael. I just want to quickly get your thought here because we are looking at 10-year yields in the U.S. 2%, almost flat, the lowest since November 2016. How low can they go in this credit cycle?
Well, I think it depends on how low the Fed needs to bring interest rates. So right now, the Fed cuts 50 to 100 basis points, call it 100 basis points. 10-year treasuries can probably trade 175, 165. If the Fed needs to go more than down 100 basis points, it can keep rallying and make all-time lows. Yields are making all-time lows, negative yields in many parts of the world. Why shouldn't the U.S., if it's part of this global issues, also make new all-time lows at some point in the next 12 months?